Venture capital due diligence is a deep dive into a startup's legal, financial, and technical foundations to ensure that the company is a sound investment. While a compelling pitch and strong growth metrics attract initial investor interest, due diligence is where investors confirm that everything checks out behind the scenes. This process is not just about risk mitigation, it also helps investors understand potential red flags, assess operational efficiency, and determine whether the startup is positioned for long-term success. Legal due diligence is a critical step in evaluating whether a startup is properly structured, owns its intellectual property, and is free from legal risks that could threaten its operations or long-term success. Investors need to confirm that ownership is clearly established, contracts are legally sound, and there are no unresolved legal issues that might disrupt the business. Several key areas are typically reviewed during legal due diligence. The first is corporate structure and governance. Investors will examine the company's articles of incorporation, bylaws, and board meeting minutes. They will also review founder agreements, vesting schedules, and shareholder rights to ensure that the company's governance framework is clearly defined and properly implemented. Next is the cap table and equity structure. The capitalization table should provide a clear breakdown of ownership among founders, employees, and investors. Investors will also evaluate stock option plans, such as employee stock option pools and any convertible securities, including safes or convertible notes. They want to ensure that there are no conflicting terms or complexities that could complicate future funding rounds or potential exit events. Contracts and customer agreements are another important focus area. Investors will closely examine major customer and vendor contracts, particularly those that include exclusivity clauses or other restrictive terms. They will also review service agreements, terms of use, and privacy policies to ensure the company is compliant and to identify any legal risks that could arise in the future. Intellectual property ownership is essential for most startups, especially those operating in technology or product-driven sectors. Investors will want to confirm that the company holds proper rights to all patents, trademarks, and copyrights. They will also look at IP assignment agreements for employees and contractors to ensure there is no ambiguity or risk of dispute over who owns the company's core assets. Finally, investors will assess any current or potential litigation as well as regulatory compliance. This includes reviewing any ongoing legal disputes and evaluating the company's adherence to industry regulations and compliance standards. For example, this might include GDPR compliance for data privacy or FDA approvals for companies in the biotech sector. Through this legal review process, investors gain the confidence that the startup is built on a solid legal foundation and is prepared to scale without hidden risks that could derail progress. Why does this matter? A messy cap table or unclear founder ownership can complicate future fundraising and exits. IP issues, like a founder who didn't sign an IP assignment agreement, can lead to investors backing out. Regulatory violations could expose the company to fines or even shutdowns. A company that is legally well-structured minimizes investor risk and demonstrates strong operational discipline, making it a more compelling investment opportunity. Ensuring legal clarity and compliance not only protects investors, but also enhances the company's ability to scale and achieve a successful exit. A high-profile legal dispute between Waymo and Uber offers a cautionary example of how unresolved IP issues can severely damage even the most well-funded companies. The conflict began when Anthony Lewandowski, a key engineer at Waymo, left to start Auto, a self-driving truck company that Uber quickly acquired. Waymo alleged that Lewandowski had taken over 14,000 confidential files, including detailed designs and LiDAR blueprints, and used them to accelerate Uber's autonomous vehicle efforts. The case resulted in a legal settlement worth $245 million and an agreement that Uber would not use Waymo's proprietary technology. Lewandowski faced criminal charges and was sentenced to 18 months in prison. For venture capital investors, this case reinforces the importance of verifying IP ownership, ensuring employees sign invention assignment agreements, and identifying potential risks during due diligence. IP uncertainty can lead to massive legal costs, reputational damage, and the loss of strategic assets. Financial due diligence is a critical part of evaluating a startup's viability. It allows investors to assess the company's revenue model, cost structure, cash flow, and overall financial stability. The goal is to confirm that the business is scalable, operates efficiently, and is not burdened by excessive debt or financial risk. There are several key areas that investors typically focus on during financial due diligence. The first is a review of historical financial statements. Investors examine the company's profit and loss statements, balance sheets, and cash flow reports to gain a clear picture of its past performance. They pay close attention to the revenue breakdown, distinguishing between recurring and non-recurring revenue. They also conduct a detailed analysis of gross margins, the burn rate, and the financial runway to evaluate the company's current financial health. Another important focus is key financial metrics and unit economics. Metrics such as customer acquisition cost in comparison to customer lifetime value, monthly recurring revenue or annual recurring revenue, churn rate, customer retention, and expansion revenue offer insight into the company's ability to grow efficiently. These indicators help investors understand whether the business model is both effective and sustainable. Fundraising history and future capital needs are also reviewed closely. Investors want to know how much capital the company has raised in previous rounds, what valuations were assigned at each stage, and how much more funding will be needed moving forward. They also assess any outstanding debt or investor obligations and evaluate whether the company has a clear fundraising strategy. Lastly, a detailed cash flow and burn rate analysis is performed. This involves evaluating how much money the company spends each month and how long it can operate before requiring new capital. Investors also consider whether the startup's growth is capital efficient or if it is overly dependent on future fundraising. Through this process, investors can better understand the financial dynamics of the startup and make more informed decisions about the risks and potential returns of the investment. Why does this matter? Overinflated revenue projections or aggressive accounting practices can raise red flags for investors. A high burn rate without a clear path to profitability can make the company a risky investment. Poor financial record keeping may indicate operational inefficiencies. Startups that demonstrate strong financial discipline and offer clear revenue visibility are far more attractive to investors, increasing the likelihood of securing funding and long-term success. The collapse of WeWork's IPO in 2019 serves as a stark reminder of what can go wrong when financial fundamentals are ignored. Despite achieving sky-high valuations and rapid growth, WeWork's financial statements painted a different picture. Investors conducting due diligence found a company bleeding cash with a business model that lacked clarity and a burn rate that was unsustainable. Further scrutiny revealed weak corporate governance, unusual related party transactions, and overdependence on continued capital infusions. Once these concerns came to light, the IPO was pulled, the company's valuation plummeted, and the CEO was ousted. For investors, the WeWork saga demonstrates the importance of closely examining financial health, realistic revenue models, and the sustainability of growth. Strong storytelling and branding may attract headlines, but without solid financial underpinnings, even the most promising startups can quickly unravel. For tech-driven startups, technical due diligence is an essential part of the investment process. It ensures that the product is scalable, secure, and capable of supporting long-term growth. Investors want to verify that the underlying technology is robust, that the development process is efficient, and that the company holds a sustainable competitive advantage. Several key areas are typically evaluated during a technical review. One of the first is product architecture and scalability. Investors assess whether the platform is built in a way that can handle increased demand as the business grows, or whether major infrastructure changes would be required. They also consider whether the technology stack is modern and maintainable, helping the company avoid future technical bottlenecks. Code quality and technical debt are also closely examined. Through code reviews, investors look at how well the software is written and whether it is optimized for performance and scalability. They aim to identify any legacy systems or dependencies that might slow down future development or introduce unnecessary complexity. Security and compliance are major concerns, particularly for startups that handle sensitive customer data. Investors will evaluate the company's cybersecurity measures and review compliance. Weaknesses in this area can lead to regulatory issues and damage the company's reputation. The development team and hiring strategy are also important. Investors assess the strength of the technical leadership and whether the company has the ability to retain key talent. They also consider whether the team has the capacity to grow and meet future technical challenges. Finally, intellectual property and proprietary technology are reviewed to determine whether the core technology is truly original or built on open-source frameworks. Investors also examine any dependencies on third-party providers that might introduce risk or limit the company's ability to scale independently. This thorough evaluation allows investors to understand the technical foundation of the business and to identify both the strengths and the potential risks that could affect future performance. Why does this matter? A weak or unscalable product can prevent long-term growth, and technical debt can slow down product development, increasing costs. Security vulnerabilities can lead to compliance issues, which can be damaging both financially and reputationally. To mitigate these risks, investors often bring in technical experts to assess the startup's technology stack and identify any potential risks that could affect long-term viability. A solid technical foundation is critical to building investor confidence and ensuring sustainable success. Theranos, once one of the most hyped startups in Silicon Valley, serves as a cautionary tale of what happens when technical due diligence is neglected. The company claimed to have developed a revolutionary blood testing device capable of performing hundreds of diagnostic tests from just a few drops of blood, a promise that attracted over $700 million in funding and a valuation of nearly $10 billion. However, the technology behind Theranos' claims was never validated. The devices were unreliable, and in many cases, the company relied on traditional lab equipment to produce results. Investors, eager to be part of a game-changing innovation, failed to conduct adequate technical reviews. Few demanded independent testing or verification of the product's capabilities, and many trusted the founder's narrative without fully understanding the underlying science or technology. When investigative reporting revealed the truth, the fallout was swift and severe. The company collapsed, key executives were charged with fraud, and investors lost nearly all of their capital. The scandal also led to broader scrutiny of startup oversight and governance practices in the tech and healthcare industries. For venture investors, the Theranos debacle is a stark reminder of the risks of skipping technical due diligence, especially in highly regulated or science-driven sectors. It highlights the critical importance of verifying that a startup's core technology not only exists, but also works as claimed, can be scaled, and complies with applicable regulatory standards. Due diligence is not merely a formality for investors. It is a critical process that determines whether a startup is genuinely ready for investment. Legal due diligence focuses on confirming that the company has clear ownership structures, valid contracts, and is in compliance with applicable laws and regulations. Ensuring legal soundness is fundamental to minimizing future risks. Financial due diligence examines the company's revenue model, burn rate, and unit economics to confirm that the business is financially stable and positioned for growth. Investors use this review to assess capital efficiency and the potential for return on investment. Technical due diligence is equally important, particularly for technology-driven startups. This step verifies that the product is scalable, secure, and defensible, giving investors confidence in the startup's ability to maintain a competitive edge and support long-term growth. Together, these layers of due diligence provide a comprehensive view of the startup's readiness for outside capital. For investors, a startup that is well prepared for due diligence can significantly streamline the investment process and reduce potential risks. Companies with organized, transparent, and well-structured documentation are far more likely to close deals efficiently and avoid unnecessary complications. Because in venture capital, the most attractive investments are not just in the most innovative startups, they are in the most prepared ones.